Welcome back. It's been a tough year for retail, and Myer's struggle to overcome sluggish consumer spending will be back under the spotlight tomorrow when it hands down its full-year results. I spoke with Roger Montgomery for more on what to expect. Roger Montgomery, great to see you again now.
Delighted to be with you.
Can we talk about Myer, which is coming up tomorrow? A lot of expectation around it.
Sure.
But of course it's been the great shorted stock on the boards, hasn't it?
Indeed. And in fact, when we first spoke many years ago and the company floated,
not too many years ago. But
not too many years ago. But the company, our valuation was significantly lower than the price. It's now about that valuation. But the prospects for the business haven't really changed. So this is a business that
you could argue they've got worse in a way.
It doesn't really offer consumers a unique selling proposition. So beyond the facade and the ground floor where they offer the cosmetics and the creams and those sorts of things, there really isn't a lot of other reasons to go into a Myer store.
But
now,
Richard Umber's sort of whole idea of recreating the experience and pushing that rather than discounting.
Yeah, but unfortunately, people are time poor. They don't really know what Myer stands for. They don't know what they're going to get when they go up those escalators. So many of them don't bother. And if you look at the foot traffic on the ground floor compared to the upper floors, you find it's pretty disappointing. So what does it really do? And I've said before, I thought that department stores were dinosaurs. I haven't really changed my view on that, and it's particularly applicable to Myer at the moment. And Umbers has a really, really challenging job to change Australia's perception of what that store does and what it can do for people.
Okay, well, we'll see what happens tomorrow. But it brings me to value investing. You're talking about the value of Myer when it floated and now. I had Jeff Lloyd from Perpetual on at the beginning of the week and asking him about when value investing is going to have its heyday again, because, of course, the passive funds and even ETFs have done so well. When do you think it's going to happen?
You look at the S&P 500, and its Sharpe ratio, which is a combination or comparing the return to the risk, is phenomenal. I mean, you don't get hedge funds that offer that kind of return. People think it's normal, though, and it isn't. 30% of the S&P 500's gain this calendar year is concentrated in 5 stocks. And that's Apple and Amazon and Google and Microsoft and Facebook. So we're seeing a higher and higher concentration of money in a narrowing band of stocks. That's always a bad sign. It's always a negative signal. But having said that, though, interest rates remain low. The economic growth in the United States appears to be accelerating gradually. So those conditions...
And elsewhere.
Those conditions are usually really good for stocks. Now, here's the other thing. If you compare the PE ratio to bond rates, bonds currently sit on a PE of about 45 times with no growth. So if you buy a stock that has some growth on a PE of less than 45 times, then on a relative basis, it looks pretty good.
Yes.
So, and there's plenty of stocks still out there. Mind you, there are some NASDAQ 100 stocks, and there's about 8 of them trading on a PE of about 240 times or more.
Yes.
So on a relative basis, things look okay, but it's a very dangerous game to play, the relative game. It's a bit like musical chairs with your money, and you think that when the music stops, you'll be able to get a chair, but there won't be a chair for everyone. So on an absolute basis, for you to accept that stocks are cheap today, you have to also accept very low returns.
Yeah.
And implied prospective returns are currently really low.
You've done a piece comparing the state we are in today to Argentina historically, which slightly gives me the willy willies. But what do you mean?
Well, Argentina recently issued a 100-year bond at 7.1%. A 100-year bond at 7.1%. Now, they ended up selling $2.7 billion worth of that bond, but subscriptions, so demand for that bond, was almost $10 billion. Now, this is insane.
Given Argentina's history.
Exactly. The last 90 years, they've had more military coups than they've had civilians as presidents. They've had 3 bouts of hyperinflation, one of 40%, one of 600%, and one of 5,000% in just the 1980s.
There's been a lot of forgiveness, of course.
There's been a lot of forgiveness, but there's also been a lot of mismanagement, and I don't think that's going to change anytime soon. The question is, if you're going to invest in the Argentinian government for 100 years, do you believe in the next 100 years there'll be a credit event or inflation or higher interest rates? And the answer to that is absolutely 100% without a shadow of a doubt. Therefore, anyone investing for 100 years in their bonds are going to see a capital loss, and 7.1% is probably not enough of compensation for the risk. And so what I'm suggesting is that the markets at the moment don't represent value, but they also don't resemble sensible conditions. We've got irresponsible investing and institutional investors locking their clients in for very long terms for very low rates. And unfortunately, until we get a cleansing and until we get some sort of correction, we won't see any sort of opportunity for value investors to invest.
If a correction does happen, do you think it's going to go across assets?
Well, we're seeing ridiculous prices in property. We've seen ridiculous prices in bonds, and I've just described that.
Yes.
We're seeing ridiculous prices in many equities, not all of them, but many equities across the world. And now we're seeing ridiculous prices paid for art, sports shoes, second-hand shoes worn by sports people, low-digit number plates, empty wine bottles in China. So we're now seeing the end of the credit boom. We're seeing money being recycled into frivolity, and often that's a sign that we're towards the end of the boom rather than at the beginning. Now, I could be a year or two early at this stage. I'm not suggesting that it's going to happen.
There's still a lot of discretionary spend around here.
Indeed. Yeah. And while that's the case, we could still see prices rise, but ultimately I think within the next 2 years we'll see some sort of a correction, and a substantial one.
I'm sure we'll be chatting about it then. Roger Montgomery, thank you very much.
Thank you.